One of the most common mistakes we see investors making is to confuse a country's long-term economic growth potential with the total return potential for a stock. Most recently, this tendency has sort of manifested itself in demonstrating a strong interest in Chinese and Indian stocks and sort of shunning American and European stocks as being old world and déclassé. This is a big mistake for a whole host of reasons. First and foremost is it ignores the concept of value. Your growth should never ever be thought of in isolation of value, and similarly, your understanding of value is very much going to be shaped by having an accurate and a realistic understanding of what the growth prospects are. The second problem with this line of thinking is it ignores the concept of risk, political risk, economic risk, capital market risk. When you invest in emerging markets, there is undeniably an incremental level of risk, and while this is by no means ever a deal breaker, you want to make sure you have a rational investment case for being incrementally compensated for assuming that incremental risk. Luxottica's growth profile is every bit as good as many emerging market retail stocks, despite the fact that its home nation of Italy doesn't lack its share of economic challenges on the horizon. Luxottica is a vertically integrated eyewear firm. It designs, manufactures, wholesales, and retails eyewear. Its retail outlets include LensCrafters, Pearle Vision, and the Sunglass Hut. Its in-house eyewear brands include Ray-Ban as well as Oakley, and it contract manufactures eyewear for a whole multitude of fashion houses, including Prada, Dolce & Gabbana, Ralph Lauren, and about a dozen others. Conceptually, you can almost think of Luxottica as a healthcare stock, but the very best part of healthcare. When investors think of healthcare stock investing, they often think that across the board they're going to be confronted with a range of fabulous opportunities because the willingness to spend to improve one's quality of life is something that transcends all culture and transcends time as well, frankly. But the reality of the healthcare stocks is that so much of the industry is so heavily regulated that the attractive opportunity set is in fact quite narrow. Luxottica is very much in the sweet spot of what we sometimes think of as being the unregulated healthcare economy, where consumers are free to spend on their healthcare needs, and companies can position themselves to capture an attractive margin accordingly. More and more consumers, as disposable income rises, are looking towards buying a second pair of eyewear for fashion purposes. At present, we view Luxottica shares as being very good value. Following the equity market correction in the autumn of '07 and the spring of '08, European large caps almost across the board became very attractively priced, and we would certainly include Luxottica in this camp. At present, we think their shares are roughly 25% undervalued. This company is a great example of why you can't confuse a stock's long-term total return potential with its home country's economic growth potential.